Hello there everyone, in today's video we're going to take a look at VAT and commercial property. As I've said time and time again, VAT, difficult at the best of times. VAT in the property world is quite tortuous, and you've got to be careful you don't get it wrong. So let's just have a little look at something that we call the capital goods scheme in the VAT world and how it interacts with the option to tax rules. So let's just take a scenario. ABC Limited company, and it buys a building. So it buys a building from which it's going to trade, and it pays £1 million plus VAT. So that's 200 grand of input VAT. So first of all, I think there's some misconceptions out there. A lot of people might think, well, it would need to opt to tax the building to claim the VAT back. Well, no, it doesn't. It doesn't need to opt to tax the building to claim the VAT back. This company, let's say it's an accountancy firm, and as long as it's making taxable supplies from that building, which it is, it's an accountancy firm, they are supplying services plus VAT on top of their invoices, it's making taxable supplies, then it can claim the 200 grand input VAT back on that building purchase that is in the limited company. No need for it to opt to tax the property. However, there is this other set of rules in the VAT world when it comes to property called the capital goods scheme. Capital goods scheme, CGS. Now the capital goods scheme basically says, if you buy, first of all, it applies when you buy buildings in excess of £250,000. So here at £1 million, we've clearly exceeded the threshold. What it basically says is, look, you can claim all of that input VAT back on day one on that purchase of the building. But if something happens in the next 10 years, we could potentially claw some of that input VAT back. That's what it's all about. So what is this if something happens in 10 years? Well, predominantly it's two things. If you cease making taxable supplies from that building, or you make supplies of the building. So what do we mean by that? Well, let's go through. So in this example, the accountancy firm, like I said, it claimed 200 grand back on day one, in year one, on the building purchase. Fair enough. Didn't have to opt to tax the property. Now, the capital goods scheme is applicable because the building costs more than 250,000. So you've got to watch what happens for the next 10 years. Now, assume halfway into that 10-year period. So after 5 years, the accountancy firm that owns this the limited company accountancy firm that owns the building, the commercial building within the limited company, says, you know what, that top floor we have, we're going to let it out. We can move a few people around, get them all on some other floors, and we're going to let out the top floor in the building that we own. Not an uncommon scenario at all. Now, here's the thing. The default position when you let out commercial property is that it's exempt for VAT purposes. So all of a sudden, so when I said, look, there's two conditions where the capital goods scheme can bite. One is where there's a change in what the company is doing, and the second one, a supply of the actual building itself. Now, rent is a supply of the building itself. So in this particular case, in the absence of not doing anything, there would be a clawback for the next 5 years of that £100,000 of input VAT. So basically we're saying you divvy up the 200 grand over 10 years, that's 20 grand a year. So for the first 5 years, making taxable supplies from the building, no supplies of the building, there's no rent being charged to anyone else, full recovery. But from year 5 onwards, one of those two conditions is breached, the supply of the building, exempt supply for rent, therefore 20 grand a year for the next 5 years will be clawed back of input VAT. That's how the capital goods scheme works. Now, in this particular case, the saving grace here would be, at that point, the company can choose to opt to tax the property. So remember, it didn't have to do it 5 years earlier when it bought the property, but at this point, if it's going to start renting out the top floor, it needs to opt to tax the property to not have that part of the 200 grand clawed back that it saved 5 years ago. So at that point, 5 years later, starts to make a supply of rent. Default is exempt. Convert it into a taxable supply by opting to tax the property. And all that means is basically that the rent charged to the tenants, you add VAT, and obviously the VAT that you pay is the VAT that you collect paid over to HMRC as output VAT. But the point is that then does not negate any clawback of the input VAT suffered 5 years previously. So that's what you would have to do. So what if number two occurs? And I said 2 situations where you can get this clawback. First is this one, if you make supplies of the building. Second one is supplies from the building. Now, like I said, these guys are accountancy business. What if the directors decide, for whatever reason, it may be commercially a bit strange, but just to highlight the example, they say, you know what? We think there's more money in insurance. We're going to hire a load of actuaries and we can make a load more better margin being insurers than we can accountants. So the nature of the supplies from that building change wholesale from being accountancy to insurance. What does that mean from a VAT point of view? Well, it means you're no longer making VATable supplies because the supply of insurance is exempt. So all the invoices from that year 5 onwards would have no VAT on them to all the customers because there's no VAT on insurance. Yes, there's insurance premium tax, but we're not talking about IPT here, we're talking about VAT. That's an exempt supply. And the capital goods scheme would kick in to say, hang on a minute, you are no longer making taxable supplies from the building, therefore clawback applies, 20 grand a year for the next 5 years of that initial 200 that you claimed on day one. So again, got to be careful. Now in that situation, there's no get out of jail card to pull by saying let's opt to tax the building like there is in scenario 1, because you can't opt to tax. In that case, it doesn't make any difference. First of all, you're not renting you're not letting anything. This is just a change in the nature of what the company is doing, assuming it's not letting the building out. It's just changing what it does from accountancy to insurance. It goes from taxable to exempt. And in that case, nothing you can do. You're knackered. You will have to have that clawback. I would say it's quite a rare thing that would happen in the real world, but that's just an example of how it would impact to show you how the rules work. But more common probably is the first scenario, which is spare space, let's let it out, but for goodness sake, make sure you opt to tax to avoid getting the clawback. So there's these interaction of rules, capital goods scheme, option to tax. And I would suggest that most people wrongly think you need to opt to tax on day one, but they don't know also that it's a way to save your skin years down the line when it comes to renting property out. So it's the interaction with the capital goods scheme. Basically, it's 10 years. You've got to look at what you're doing for 10 years after buying a building if you want to claim VAT back on the purchase. So just an overview there of something just to illustrate the costly issues that can occur. So if you are buying a building and it's got VAT charged, commercial building, for goodness sake, have a think about all of this capital goods scheme, 10-year rule, interaction with option to tax rules, because if you get it wrong, it can be costly. But like I said, it all is not lost on the rental side, at least, if you do have that option to tax in place. So food for thought there on some nuance around VAT and properties. If you like this video, please do subscribe. And as always, I'll see you soon.